Of all the features of options trading, volatility is perhaps the most ubiquitous. In many ways, it encompasses all of the activity that happens with an underlying. Volatility is measured everywhere. The indexes that make up the Dow Jones Industrial Average, the S&P 500, and the Nasdaq 100 each have their own volatility components, as do the individual stocks that compose those indexes. Volatility is simply a measure of the price action of a stock. It's defined by Wikipedia. Volatility is the degree of variation of a trading price series over time as measured by the standard deviation of logarithmic returns. While mathematically correct, it's hardly helpful to give you a sense of what volatility actually is. Volatility is most often associated with fear, but one reason I don't like focusing on that perspective is because there are more mundane reasons for volatility to fluctuate that have very little to do with fear and the emotions we typically relate to it. Large institutional investors aren't afraid of investing, nor are they fearful of missing out necessarily, though sometimes they are. But they do pay attention to how the market moves and they are looking to make a profit. That's bound to cause a little anxiety in anyone who's putting millions of dollars at risk. Another way to look at volatility is as the magnitude of concern about the pricing of an option. It's not quite fear, but rather a low level agitation about what the pricing should be, coupled with the desire to invest or divest your money. Volatility can increase even if there's no particularly obvious reason for the market to be, quote, fearful of a given stock's price action. Just because you, as a retail trader or casual observer of the stock market, doesn't see any major news cross the headlines doesn't mean there isn't something going on in the market. You just don't happen to know about it. Market makers are much more keenly aware of such concerns, both in the moment to moment perspective as well within the larger news cycle. It's part of their role as the creators of liquidity in the market, and when they become concerned about a particular stock or the market in general, they hedge their strategies appropriately, driving volatility up, or letting it settle once the crisis, big or small, passes. Market makers can ask for continually higher options prices, irrespective of the direction the underlying is moving, if it's moving at all, due to the supply and demand caused by the increasing magnitude of concern. This exhibits itself as an increase in the volatility, and in turn, an increase in the price. Market makers are big influencers on volatility, as they trade millions upon millions of shares over the course of a day, or even hours, in order to keep the markets liquid. In doing so, they increase or decrease the pricing of the options based on the mathematical pricing models, and this takes a form of the intrinsic value added or subtracted from the option. The anticipated change in pricing is called the implied volatility. So where does this concern come from? Supply and demand is the major factor. In the case of a known event that might dramatically change the price of the underlying, such as an earnings report, there will be much more attention paid to the activities surrounding the underlying. News and speculation can cause the volatility to fluctuate quite a bit. Typically, the very movement of the stock can shock the volatility into changing. Sudden down moves can cause the volatility to steeply increase, while confidence in an up move can cause it to decrease, albeit usually at a slower pace than when it drops. Once any significant event has passed, and all of the information that drove that concern is now comfortably known and accepted by the market, typically the volatility will drop because the market no longer has a pressing need to adjust their hedges like they did when the event was approaching or suddenly occurred. I say typically because sometimes a binary event will occur, but the volatility will remain high. This is true if there seems to be a lot of excess trading still occurring. If not everything is immediately resolved after the event, there is still concern in the market. Again, volatility can rise or drop significantly irrespective of price movement. It's not exactly movement that drives volatility, it's the pricing gaps that need to be filled by the market makers. That's why you can have a stock drop and the IV drop at the same time. The two factors, volatility and delta, may, and often do, correlate due to the external circumstances, but they do not necessarily have causal relationships. Earnings reports are always good places to watch how volatility behaves. It often rises, sometimes quite a lot as the earnings report date approaches. If you look back at most earnings, volatility drops following the earnings report, and especially the earnings call itself. Investors want to hear the company officers tell their side of the story, and they make a judgment after that. In more practical terms, there are two types of volatility to be concerned with in basic options trading: historical volatility, sometimes called realized volatility, and implied volatility, IV. Historical volatility is exactly what it sounds like. It is the actual volatility as recorded over a past period of time. Implied volatility is forward-looking and is the theoretical value of the price based on a mathematical pricing modeling equation such as the Black-Scholes-Merton model.
Volatility is expressed as a percentage, ranging from 0 to over 100% in rare cases. What is considered high is not necessarily that the IV has reached a certain threshold, say 70%, but is more dependent on the historical action of the volatility. There are mathematical ways of normalizing the IV so that it is more consistent with most people's mental models. Such a normalization is called the IV rank or the IV percentile, depending on the underlying derivation. Regardless, it measures the same thing, the degree of concern or fear around how underlying stocks should be priced at any given moment. Volatility is a story in itself. It encapsulates a lot of elements that drive the pricing of options. At its most basic, it is the measure of the degree of variation in an underlying price over a period of time. It shows up in how market makers hedge their positions and create liquidity. Volatility shifts with the same news and speculation that influences the actions of institutional and retail investors alike. And time also plays a role. As a known event approaches, IV might increase in anticipation. If a binary event was unexpected, IV might spike and then take a lot of time thereafter to decrease, or, depending on the nature of the event, it may drop off steeply. There are categories of options trading based almost solely around volatility. No strategy can avoid the impact of volatility. Sudden spikes can make or break the profitability of a position, and a trader well versed in volatility can use it as a tool to their advantage, increasing their probability of making a profit.